Welcome everyone to the last seminar in the spring series. And Jurre, you have 50 minutes. Take it away.
All right. Thanks very much for having me. Thanks also very much for organizing. I've seen some very interesting things over the last couple of months. And given that this is the last one, let's try to go out with a bang. So this is joint work with Aljoscha Jansen. And this is basically the first time that we present this having any kind of results for this project. So we are very interested to hear what you think about it and where we are now with this project. So what do we talk about? So this paper is about what we think is an important market, namely the market for mutual funds. And mutual funds are important because they are an important mechanism for retail investors to invest their money and to participate in the stock market. So for example, in the US, about 10% of household financial wealth is invested in mutual funds. So that's a big chunk. Now, today we are going to look at competition in this market between two broad classes of mutual fund. And the first type is what is called an actively managed fund or an active fund. And such a fund has a fund manager that claims he or she is able to beat the market and is going to pick particular stocks in order to do so. The other type of fund that is present in this market is what's called a passive or an index fund. And they don't really try to beat the market as such. They just invest according to a pre-specified index, such as the S&P 500. Now, there is a very large literature in finance that documents that ex ante passive investing beats active investing for most people. And an important reason for that is that the fees that passive mutual funds charge are much lower than the fees that active mutual funds charge. So they are much lower price, basically. Now, our interest in this market and in these two particular types of funds is based on sort of two stylized facts that we uncovered and that I want to share with you, and then you'll hopefully see why we think this is interesting to talk about. So the first stylized fact is about the market share of active and passive funds. So here we've just made a plot of the market share of both types of funds in total. Passive funds were basically invented in the early 1990s. So if they start at zero, that's normal. And we see that over time, their overall market share increases. Now, nevertheless, we see that even now, a sizable fraction of the market, so a bit less than half, is still invested in active funds, even though basically every academic in finance would recommend that you always buy a passive fund over an active fund. Now, this fact is widely known and also has been looked at a bit before. The next stylized fact we found was not well known, and we were also quite surprised to see it. So here we have the same thing, but instead of quantity, we have price. So on the y-axis here, we have some measure of price. I'm going to explain later exactly what this is, but for now, just think of the y-axis as price. And we see two things here. So firstly, just to confirm what I said before, which is that passive funds charge much lower prices than active funds. But what sort of caught our interest is the way that active funds responded to the innovation or the entry of index funds. Because you basically see, if you look at the 1990s, that active funds did not lower their price whatsoever after passive funds entered the market. And even up to today, the price difference between active and passive funds has not shrunk whatsoever. And this is kind of hard to reconcile with a standard model of competition, right? Let's say a perfect competition, because essentially we have entry here by lower marginal cost entrants. Our passive funds have lower marginal costs because they don't have to hire finance types to pick stocks. So then normally we would expect that the incumbents also lower their price, right? And we clearly don't see that happens. So that means that there must be some source of market power that active funds have that allow them to not compete on price whatsoever, even though we have this low marginal cost entrant that we see in the data also is able to sell to many consumers. So the question is basically, what is the source of market power? So in the way that we're going to think about it is we're going to try to explain a bit this puzzle raised in finance, which is what can explain this continued investment into active funds. And we're going to basically focus on two competing mechanisms. The first one is that some consumer might have a preference for active investing. This preference might be misguided, but nevertheless, they might feel that active investing is better, right? And the other mechanism is that there is some kind of market friction in the market. And of course, particular, no surprise, the friction we have in mind here is that there are some kind of surge cost in this market, right? And then basically the story would be that in fact, consumers maybe do prefer passive funds, but they're simply not able to find them. So given then that we can explain on the demand side what's happening, the next question will be, can we then rationalize why active funds do not compete on pricing whatsoever? And then finally, and that's why I think this is important questions to ask, going to ask questions, what does this mean for how we think about policy and investment advice in this market? And as you see, this is a bit work in progress, but I give you already some insights into that today. And to give you one example, why we think this is not obvious, is that, like I already said, the main reason, or one of the main reasons, that the standard advice is buy passive is because they are cheaper. But of course, price is a market outcome. So it's not at all obvious that if we encourage, for example, consumers to buy more passive funds, say by lowering search cost or by somehow informing them, that this price difference is not going to shrink. So basically what we want is to have a very serious model of the supply side of this market, so that we can seriously think also when we make policy in this market, how are the firms going to respond to that policy? Now, how do we do that? So firstly, we're going to briefly document a bit of stylized facts about the development of the US mutual fund industry. And then we're going to build a structural model of random search in this market that's going to estimate everything that we care about. And then the estimated model is hopefully given some insight into how the different mechanisms play, both on the demand side and on the supply side, and of course also to think about counterfactual policies. Now let me spend a bit of time, because it's not completely obvious maybe where we are in the literature. So firstly, of course, we are very related to a rich literature about the empirical model of search. There are many papers that estimate models of search based on consumer level data. We are on market level data, so that's a bit different. And then there are, I think, two papers that are really important to mention here. The first is obviously Hortaxu-Syverson, which also estimates a model of random search in the mutual fund market. So how are we different? So I think there are two differences. The first difference is substantive. So we ask a very different question than they do. So Hortaxu-Syverson look at a very small subsegment of the market, namely a particular type of index fund, and try to explain why is the price dispersion for this index fund, right? We look at the whole market and then try to explain how does the competition between those two broad classes of mutual funds work. Now, as a result of that, and that's the second difference with Hortaxu-Syverson, of course, if you have different types of mutual funds, we have to account for the fact that different consumers have different preferences over these funds potentially. So we are going to add to their model aspect of horizontal differentiation. So that is a technical difference between their model and ours. Now, a second model, empirical model of search on market level data is Moraga Gonzalez, Sandor Wilde based. Maybe the year here should be 2020. But in any case, the difference is, right, their model is a model of directed search and our model is a model of random search. And it's not just to be different. We think that's important here for two reasons. Firstly, because Hortaxo-Syverson is random search. So we want to kind of contrast our findings with them. So it's important to have the same thing. But also, like I already alluded to a bit before, the concept of price, for example, is already very complicated in this market. So we think one of the things that consumers search for is how much does a mutual fund in fact cost? That's not easy to understand. And then it's difficult to believe that they direct their search on price, for example. And then we think that random search is going to be a more realistic explanation of the search process. Secondly, maybe a bit less interesting here, we also contribute to a literature from finance about investor behavior in the mutual fund market. There's, of course, been various explanations given for why consumers still buy active mutual funds. And one of them, of course, is that there is some kind of friction in this market. And we are basically in this line of thinking and try to make this formal. Now, before we begin, let me briefly preview the results. I should say the results are preliminary in a way that I'm going to make exact at the end. What I mean by that. What we have is basically the following. We find that consumers have a very strong preference of active funds over passive funds. So that exists. But we also find that search costs are also quite large. However, they are lower than in models without horizontal differentiation. So accounting for that is important. Now, then if we disentangle, somewhat to our own surprise, to be honest, we found that actually most of the investment into active funds can then be explained by preferences. So even though search costs are sizable in this market, our results indicate that this does nothing almost to explain why consumers do not invest more into index funds. Good. So let me first explain a bit more about the industry and the data and things like that. So our primary data source is the Morningstar database, which is a large database essentially of all the mutual funds that are available in the American market. And we have a very long panel. So we're going to look at the market from 1993 to 2018. And of course, there are two types of investors active in this market. Retail investors as well as institutional investors. We think the story for institutional investors is a bit different. So we focus on mutual funds that are aimed at retail investors, but otherwise we look at the whole market. Now, to this data, we're going to add some data on the outside option of the market. So wealth that is not invested into mutual funds, and that's going to be actually quite important in our model. And this data we get from the Federal Reserve, which provides aggregated data on what fraction of households' financial wealth is invested in mutual funds. Now, let me just briefly explain a bit how we think about mutual funds and the types of differentiation that mutual funds have in this market. So basically, a mutual fund is some kind of investment vehicle that invest into stocks according to some kind of strategy, right? And for index funds, that is a very fixed strategy. So they just blindly follow an index. But even active funds typically have some kind of strategy. So they might focus on large cap stocks or small cap stocks, or on energy or something like that, right? So that is one aspect in which mutual funds are differentiated. Now, some other variables that matter that we're also going to control for is, of course, the firm that sells it. Is it a passive or an active fund? We know that past returns are very important in the behavior of retail investors. So retail investors chase returns from the past, basically. And then we're going to use as a measure of market share the total value of the assets that the mutual fund has under its management. Now, then I should say something about the price, because like I already alluded to a couple of times, price is a complicated beast in this market. Because if you invest in a mutual fund in the US market, there are many different types of fees that you could pay, and they differ from mutual fund to mutual fund. So for example, some mutual funds have what is called a load, and a load means that as soon as you buy the mutual fund, you pay a one-time fee, sort of as a purchasing fee, right? Some other mutual funds have a management fee where you pay a percentage every year. And then even more funds have both, but for some the load is more important, and for some the other fees are more important, etc. Right? So basically, we need to have sort of a nice standardized measure of price in this market, and we use one that is a bit standard, which is called the net expense ratio. And the net expense ratio is just the ratio of the total fees that a fund charges to its investors, proportional to the total amount of assets that it has under its management. Now,
can I ask a question?
Yes.
It is about the random versus directed. So isn't it that basically investors typically start investing, say, at the banks at which they have their own accounts, right? And that because of this, every investor actually is going to start searching, let's say, among the products offered by the banks at which they have their savings. And this actually would imply that, well, as far as I know, this market, the banks also offer discounts, right, to their own clients, right? So right. I think that, this could lead to a kind of model of search, maybe not via prices, but via brands, like a directed search, but directed by brands, no? Is this something that might be, you think, important also in the US? I don't know how it works over there.
Yeah, so I think in the US it's a bit less important than in Europe. Not saying that it's not happening, right? And the reason for that is that many of the largest suppliers of these funds are completely independent from banks. So, for example, the largest supplier of these index funds is a company called Vanguard, and they have nothing to do with any bank whatsoever. Now, nevertheless, of course, it is true that these kind of links might exist, or there might be kickbacks or something like that. And basically, how that's going to be reflected in our model is through firm fixed effects. So we're going to have brand fixed effects for every product, and these are going to capture things like advertising, but possibly also they're going to capture the fact that some have lower search costs, or that some are earlier in the search order, etc. So we don't deal with it directly, but we do think that we can capture it to some extent.
Just a follow-up, because I'm trying to figure out the market here.
Yeah.
So with the active funds, though, are those more likely to be what your own bank pushes on you in the US?
That is probably true. For the simple reason that they make more money, right? So there is sometimes a sales charge, right? That if you sell a mutual fund, then you get some money. The sales charge is typically larger for active funds than for passive funds, right? So in that sense, some of the middlemen in the market have an incentive to push active funds, yes.
Should we be worried then that if there was a directed search model, that the lowest search cost options might be the active funds, and then that would be what's driving this dynamic?
The lowest search, well, I mean, then it of course depends a bit, right? Then of course it's not really that these funds have lower search costs, right? So if you would have a model with different search costs, you would capture that by lower search costs, but they are not really lower, right? they are just advised, or they are earlier in the search order, right? So it depends a bit, where do you want to put the particulars of the market, right? And I agree, we do simplify a bit, but basically putting all of it on the firm fixed effect, right? And this is going to capture a lot of the details that both you and Jose mentioned here. Right.
Thanks.
Okay, so let me give you a little bit of data on this market. So firstly, just to note that the number of funds in the market is very large, right? And that automatically gives a role for search, but it's also going to be important during our model. So keep that in the back of your mind. Then secondly, we see, if we look at the first 7 years of our sample, we see that basically active funds had the whole market. And we see, if we look at the last 8 years of our sample, that passive funds have a much larger share of the market. And if you look at the net expense ratio, so the price again, we see that both decreased their price from the beginning to the end of our sample, but passive funds decreased their price much more than active funds. And to this kind of indicates that passive funds somehow sell to consumers that have demand that is more elastic than the consumers that active funds sell to. So to kind of get a handle of that, we do the following. We basically regress quantity, so market share on price, and a bunch of controls. We do that for both passive and active funds, and we just see what is the correlation between a fund's price and a fund's market share, how this evolves over time, right? So this is not causal, to be clear, right? But just the correlation, right? And we see that sort of in the first 10 years after passive funds were introduced, but our market share was very small. We see that the demand for active funds seemed to be, in some sense, reasonably elastic. So there's some negative correlation between an active fund's net expense ratio and its market share. Now, as passive funds kind of got a foothold in the market, the pattern started to flip. And we see in the last 20 years or so that the market share of a passive fund is much more negatively correlated with its price than the market share of an active fund, which to us, again, indicates that there is something about the consumers that these active funds sell to that makes their demand being less elastic. And then the question is, what is it about the consumers that active funds do sell to so that the demand is less elastic? And for that, we go to the structural model. So the model itself is very easy to explain, and estimation is more difficult to explain. But let me give the base model first. So the model is basically just BLP plus random search, as you would expect. So let me give you a couple of details that might be important. So firstly, on the BLP side, we basically just have preferences. This is the preference of consumer I for mutual fund J. That depends on some of the product characteristics that I showed you before. On the price, there's some kind of shock to the quality, and then an error term. This sort of discrete choice formulation, right, is sort of standard in the literature. There are multiple papers that use this to look at the mutual fund market. But it is, to be fair, a bit of a simplification, right? Because in practice, consumers buy a portfolio of multiple mutual funds, right? And here we basically assume that every dollar is invested independently from every other dollar. Now we're going to have random coefficients on the price, but also on an index fund dummy, right? So we're going to allow consumers to have different preferences for active funds or for passive funds, which of course is going to be important for us. And I should say something about the interpretation of these preferences, namely that we view this as purely revealed preference, right? So you might think that consumers have some kind of real preference where they care about just maximizing the money that they make, for example, from the mutual fund. And they might be misguided in the way that certain funds are gonna aid them in that goal. We are just trying to explain what do they actually choose, but that does mean that things like calculating welfare are a bit difficult here, because we do allow for the fact that the choices that consumers make are maybe not the choices that they should make if they care about making the most money. Now we are going to have random search, so consumers need to inspect a product to buy it, and we're going to have also different search costs across consumers. And the search cost is going to consist of two components. There's going to be an individual level search cost shock, which is going to follow some kind of distribution that we're going to estimate, plus a market level shock. So basically, we allow the whole distribution to shift to the left or to the right in every period. And that's going to be important for us because we have a very long panel. So of course, it's possible that search costs have gone up or gone down over time. So we completely allow for that. We have free recall. We have that consumers can know the value of the outside option and can buy that without search. But the first search for inside good is not free. So we're going to have an extensive margin of search here. And in fact, this extensive margin of search is going to be very important for the estimation of the model. And then finally, consistent with many papers in the theory literature, but not all of them in the empirical literature, we're going to assume that consumer beliefs are passive, but of course they are correct in equilibrium. Now, so the model formulation, I think, is what you would expect. The estimation, we make quite a few new arguments, and it's very non-standard. I don't have time to go into all the details, but I kind of want to give you the overall flavor of what is going on here. So basically, we're going to estimate it in two steps. So in the first step, we're going to estimate the preference parameters alpha and beta. So these would completely determine demand in a market where there were no frictions. And we're going to show that you can just do that with BLP. And in the second step, we're going to uncover search cost and marginal costs with some extra moments. So let me explain how we get BLP first in this market. And that follows from a derivation of the eventual probability that a consumer buys a certain good. So as everybody here knows, I don't think I have to explain this here, the probability that a consumer I buys product J, if it inspects it, can happen in two ways, right? You can either say that you like the product at once, so the value of the product is above your reservation value, and you get an immediate purchase, or the value of the product you are inspecting is below your reservation value, and then you go on searching. And then the only time that you buy product J after not purchasing it at once is when you inspect all the products in the market, and then you come back to purchase product J. Now, the trick that we use here is that if the number of products in the market is large, then this second term, so the probability of a comeback, goes to zero, right? And remember, we have over 3,000 products in our market, right? So we think for our market, that's a nice approximation to make. So the first thing we're going to do is we're going to basically say, we're going to set this comeback probability to zero, and we're going to approximate the model with a model where there is essentially an infinite number of firms. Now, why does that help? Well, that means that we can write the probability that the consumer I buys product J conditional on its searching as follows, right? So we have here in the numerator simply, okay, you actually inspect product J and then you buy product J. So that's the same as we have on the left. And then the denominator here is simply 1. Why? If the number of products is large, it means that as soon as you search, you are always going to buy something, right? The only way that you search and you don't buy, is if you inspect all the products, they're all crap, and then you buy the outside option. So as the number of products become large, the probability that you buy any product conditional on searching becomes 1. So we just divide here by 1. Now then, if there is random search and consumer beliefs are in equilibrium, then these probabilities that a given consumer visits any products are going to cancel, and we get that the probability that a consumer buys a particular product follows this thing. And this looks kind of like a logic, right? So here we have sort of like a discrete choice formulation. And in fact, we show if you make some additional assumptions, you get exactly a BLP formulation for the equilibrium market shares, and even a formulation that does not depend on search cost. So basically, you don't have to account whatsoever for search cost when you estimate the underlying preferences in the market. Let me briefly say a bit about the assumptions that we need to make. So we need to make a non-standard functional form assumption. That's not a big issue, but we need to make 3 assumptions that do matter. So the first assumption, like I already said, is that the number of firms is large to get the comeback probability towards 0. The second one is that consumer beliefs are in equilibrium. And that's a standard assumption, but that's important to mention because this is not the demand function in the market. This is only the demand, this is only the formulation for the purchasing probabilities in equilibrium. Because consumers have passive beliefs, as soon as one firm charges an off equilibrium price, we are going to have something different. So the fact that we get BLP does not mean that search costs don't matter. It just means that you can ignore them during the estimation. And then finally, we need that the search costs are not too large, because if they are too large, then one of these probabilities here becomes 1, and then we get into all kinds of issues. And luckily for us, we can calculate the upper bound, and we can compare these upper bounds with the results from Hortaxu-Syverson. And we think that in our case, based on that these upper bounds are not going to be important. Now, given the estimation of the preference parameters, we can disentangle the search cost. I'm going to be a bit brief here for the interest of time, but let me just say what is the main problem that we have and the main solution that we use. So the main empirical problem that we have is that we need to disentangle preference heterogeneity from search cost heterogeneity. And to do that, we need something that shifts the distribution of search costs of consumers active in the market, but does not shift the distribution of preference of consumers that are active in the market. And the intuition here is that changes on the extensive margin give some information about this. So the idea is the following: all other things equal, if more consumers start to search, then these marginal consumers that search will on the whole have higher search costs, right? So that means that the number of consumers that are searching is informative about the distribution of search costs in the market. Now, of course, the key term here is all other things equal. So we need to control for all other things that might influence why consumers search or not. In the interest of time, let me just boldly claim that we are able to do this. And if you don't believe me, we can discuss after, or I can send you a draft at some point where we explain in more detail what's going on. So let's talk a little bit then about the results that we obtain. So firstly, let's start with estimated search cost. So this is the development of estimated search costs over time. So we see that search costs decrease from the beginning of our sample, and then sort of since the 2000s, there's a little bit of movement, but they have been quite stable. Now, what is nice here is that we can compare these results with the results from Hortaxu-Syverson to see if our results make sense or not, right? Because we use quite a different method of estimating the market. So we can see, can we still get what they have? Now, in Hortaxus-Syverson, they looked at the period 1995 to 2000, and they also found a very large decrease in search cost over that period, right? So it's very nice that we can replicate using a very different method the same observation about decrease in search cost over time. Then, if you think about magnitudes, right? So do the search cost, are the search costs that we estimate, do they differ from there? It's a bit more difficult to say, because unfortunately they do not give like one number for the mean search cost in our paper, but we can compare a couple of things. So for example, in the year 2000, we find search costs that are about half on average than the search costs that are found by Hortaxus-Syverson. And that is somewhat reassuring, right? Because we're in the same order of magnitude, but also we are somewhat lower, right? Now, the fact that we are lower is in itself not surprising, right? Because the difference between us and Hortaxus-Syverson is that we also have horizontal differentiation, right? So in their paper, they have to put all the differences between consumers and also all the market power that firms have on search costs, right? And we have an additional source of market power, namely horizontal differentiation, that can explain what's going on in the market. So it's not surprising that they are lower, the search cost estimates. The only question is how much lower. And we basically find that they are quite a bit lower, which indicates that if you do not control for horizontal differentiation, at least in this market, you are quite likely to significantly overestimate the level of search costs that are present in the market. Now then, let's think a bit about search cost differences. So we go ahead.
Can I also ask something? Can you give me some sort of a dollar measure of the search costs or something like this?
That is a bit difficult to say. We chose the same y-axis as them, so that's why. So this is in basis points. So 100 basis points means that if you invest $1, you spend 1 cent in search costs, right? So this means basically here that for every dollar that you invest, the search cost is 1/1000th of a dollar in 2000, for example.
Mm-hmm. Okay.
Right. Yeah, but you know, this is the downside of having this. The price is not measured in dollars here, so it's a bit difficult to get a clear view of that.
And it's proportional directly to how much I invest. That's how you estimate.
Yes. So that's the result from the assumption that we have a discrete choice formulation. Yes, that is proportional. Yeah.
If I may ask another question, so if I remember well, Hortaxus and Syverson, they were actually puzzled by this fact that search costs were going down, but prices were increasing. Of course, you are using a different measure of prices, I believe. But if I remember well, they were saying, yeah, search costs are going down, but prices are increasing. How can we explain that? And they say, if I remember well, that there was an entry of investors in this period, because this is a period of, let's say, opening up of banking markets, and then people could start investing from home, home investors, etc. And they more or less say that in this period, 95 to 2000, there was an entry of less knowledgeable consumers or investors who were less savvy. And because of this, that's the argument they give for explaining increase in prices. Is this something you can actually deal with here? Capture here?
Let me say two things. So first, I didn't find an increase in prices, but an increase in price dispersion, right? Just to say what they were doing. So what you are saying is a good question. We cannot find it, but that's by assumption. So basically, in Hortaxus-Syverson, they have the advantage because they don't have any differentiation. They can get a non-parametric estimate of the search cost distribution, right? And we have to make an assumption that these distributions follow a certain that these follow a given distribution. And that makes it difficult for us to find what they find, for example, that the tail of the distribution becomes thicker. But that's not that we don't find that, it's just that we cannot find it, basically.
I see. Okay, I see.
Just to let you know, you have 10 minutes.
Perfect. Good. So this is mean search costs. And then let's think a bit about differences in search costs across consumers. So firstly, we find that consumers differ quite a bit in their search cost, actually a bit more than what is found by Portax and Syverson. And then we can think about which type of consumer buys which type of fund. So this is not a counterfactual, to be clear. We just look at the equilibrium that we estimate. What is the search cost of consumers that we estimate active funds and passive funds? And as you can see, we find that consumers that buy active funds on the whole have higher search costs than consumers that buy index funds. In particular, in the tail, you see a lot more action. Now, you have to be a bit careful though here, because this does not mean that these consumers buy active funds because they have higher search costs. And the reason for that is that we find that search costs and consumers' willingness to pay, so how sensitive they are to price, are very heavily correlated. So basically, we find that consumers that have higher search costs are also much less sensitive to price. And it would also be that way in a world where there were no search costs. Right? So even though we find the correlation in the data between consumers with higher search costs being more likely to buy active funds, that can also be because consumers with higher search costs on the whole are less price sensitive and active funds have higher prices, right? So it can be like a false correlation and not necessarily causation. So to really get into the mechanisms, we have to calculate some counterfactuals, which we'll do in a bit. Before that, let's also discuss a little bit about differences in preferences. So these are preference differences for the index funds. So these are the coefficients from the demand model. And basically, we see that the coefficient on the index fund dummy is basically the same as the coefficient on the price variable. And that means that on average, a consumer is willing to pay 1 percentage point more in net expense ratio to buy an active fund and not a passive fund. And to give you an idea how much that is approximately equal to the average price in the market, right? So in other words, the average consumer is willing to pay the average price in the market, so double the price, to buy an active fund and not a passive fund. So on average, consumers have a very strong preference for active funds. However, as you see in the second column, there is also very large differences from consumers to consumer here. So the standard deviation of this preference is approximately 1/3 of the mean value. So there are some consumers that are much more willing to pay for this than others. Now, to really get into what's going on in the market, we compute 2 counterfactuals. So in the first counterfactual, we think about what would happen if search costs would go down. And what we do in particular is we decrease the mean search cost by 1/5 and then just shift the whole search cost distribution to the left. And what you see, if you compare it to the baseline, is that nothing happens, basically. The market share of the index funds stays more or less the same. And there's almost no effect on the prices that index and active funds charge. So the only effect that we get is on the size of the market, basically. So the amount invested in mutual funds increases by about 5% if we decrease search costs by 20%. And that's, of course, logical, because if you decrease search costs, more consumers are going to search on the extensive margin and hence be active in the market. Now, what is the reason that changing search costs does not really have an effect on the equilibrium? And to think about that, we have to think about what is the marginal consumer in this market. And as it turns out, the marginal consumer in this market is a consumer that kind of has preferences that are not very different than the mean preference in the market. And the reason for that is that in the baseline, there are two types of consumers that search, that self-select on the extensive margin. The first type is consumers that have low search costs. But remember, these are correlated with the willingness to pay. So those low search cost consumers, on the whole, are very price sensitive. Right? On the other hand, we have consumers entering that are very price sensitive. They tend to have high search costs. Right? So what's left are only the guys in the middle. So if they enter in addition to the consumers that we're already searching, basically not so much happens, and the equilibrium stays the same. Now, we get a very different story if we change the preference that consumers have for active funds or passive funds. So here we lower the willingness to pay, average willingness to pay that consumers have for active funds by also 20%. And then we readjust the market such that the total utility in the market remains constant. And if you do that, we get very stark outcomes. So you see immediately that the market share of index funds becomes over 90%. So if you reduce the preferences for active funds by just a little bit, index funds at once take over almost the whole market. Now, that does come at a price, because we see that the size of the market goes down by about 1/5. And the reason for that is that now it becomes more difficult to find the products in the market that are good, right? We basically shift some of the benefits that consumers can get from active funds to passive funds, but the passive funds are much more rare. They're hard to find. So then high search cost consumers choose to no longer be active in the market. So we do find very clearly here that it is not search cost, but it is preference that can explain at least the demand for active funds. Now, what we cannot explain yet, and that you can see in the last two rows here, is why active funds price the way that they do. Because we see even if we decrease the willingness to pay consumers have for active funds, that active funds do not decrease their price. And the price difference between active funds and passive funds goes down somewhat. So we can explain it a bit, but not to a very large extent. So we are a bit puzzled why that is the case, and we have one idea why that is, and I'm going to end here. And the reason is that I've kind of talked to you already, that this correlation between the preferences and self-selection on the extensive margin are very important. And basically what we have now is that consumers' preferences for active funds and their search costs are assumed to be independent. And that's probably not true. So if you would allow for a correlation between consumers' preferences for active funds and their search costs, we think we can get different action on the extensive margin, and then we can possibly find some counterfactual in which we can get lower prices also for active funds, which would allow us to explain the pricing of active funds in the baseline, right? But so far we can find that preferences explain very clearly the demand side, not so much yet the supply side. So I'm going to leave it here. So thanks a lot for your attention. If there are any further questions or comments, of course, very happy to hear them.
Thank you for a great presentation, and you're perfect on time. We now open it up to questions.
So maybe I have a question. So you say preferences can explain demand much better than search cost, right?
Yes.
Is this also an artifact of this infinitely many firms assumption? Because you also said that because of this assumption, you can also estimate preferences ignoring search cost, right? Is there a relation between these two observations or not?
Not necessarily. So I thought about it. I mean, I think your intuition is not wrong. So basically, right? If you are correct, if you fix the set of consumers that is active in the market, and you fix prices, then as a result of this infinite number of firm assumption, then we get that it doesn't matter what the cost of search are, right? But if we change search costs, then two things happen, right? Firstly, there's going to be a different set of consumers entering the market, right? And that will matter also in the BLP part of the model, right? And there's going to be a second mechanism also possibly through prices, right? So we could have found, for example, that if search costs would go down, that then consumers with preferences that were very different from those already in the market became active. And then we would also get a very different demand outcome. So I think your intuition is not wrong, but I do think that we could have found something else.
Okay, thanks.
Can I ask something about related to what I asked before?
Yes.
In the sense that it's funny for me to think about search costs as depending on how much I invest. That somehow it makes more sense for me to think about them as a function of how many funds I invest into. So do you know, for example, whether the chaps that invest into index funds and into the active funds, whether they invest into a similar number of funds as well? Because I presume many people invest into actually more than a single fund. Right?
Yes. So that's a great question. So I don't know, but I think it's a great idea to check. So basically, this is completely an artifact of the fact, right, that we don't have data on the level of the consumer, right? If we have data on the level of the consumer,
okay, yeah, sorry.
Seriously about what you're asking, right? We only have market level data, so we don't know the distribution of how much consumers invest into different things.
Okay.
But I agree completely. That's a downside of the approach.
Yes. Then related to this, what moments are you using to estimate such costs in the second stage? Yes. They are not such related moments, right?
So the firm's first order conditions, that's one. Okay. And then secondly, basically what we have that's new is we estimate these shocks, right, to the search cost distribution. And we have instruments that we claim are uncorrelated with search costs, but do determine participation into the market. So in particular, what we have is the business cycle. So we observe that if the economy is doing well, that the more consumers invest into mutual funds. So we do see that this shifts participation, but we think that this should be uncorrelated with search costs because this is more about long-term changes in online brokers and things like that. So that's kind of how we identify the distribution of search costs. That's at least our argument.
Oh, I see. Okay.
Yeah. So would that be uncorrelated with search costs though? Just kind of thinking through, if you have hobbyist investors, they might be more likely to be in the market.
No, but mean search cost, right? So we have a distribution of search costs. Yeah. And we shift to the left or the right, and we're saying that these shifts are uncorrelated with the business cycle. Yes.
Any other questions? Okay. Thank you all for a great series. I'm going to end the recording here and see you all later.